Stop having PTSD every single tax season. The IRS does not deserve your anxiety. What you need to do is be able to leverage a tax code so that you can legally reduce your tax liability. When you're able to leverage a tax code, you can dictate, potentially, what you pay in taxes so that you can protect your cash and grow your business. Now, I'm not promising you're not going to pay taxes, right? In this episode, I'll share that with proper tax strategy and tax planning, that you could potentially end the year with no tax surprises. Stay tuned. This is the Harmonious Wealth Podcast, where we're breaking online business owners free from chasing every next revenue milestone and instead prioritizing lifestyle and legacy goals so you can finally have the personal wealth to show for your business success. I'm your host, Iyanna Vaughn, fractional CFO and bookkeeper, here to guide you. Now let's start building your financial legacy. Hello, welcome to another episode of Harmonious Wealth. My name is Iyanna Vaughn. I am so excited to talk about how to dictate taxes. By the time that this is going to air, it's going to be the end of May. So we would have already gone through a tax season. So maybe you just barely survived tax season. Maybe this is the second year or third year in a row where you did an extension to avoid filing just an extension, right? You just kind of wanted to give yourself more time. But what you want more than anything is to be able to dictate what you pay in taxes so that you can protect your cash on hand as a business owner. Being able to predict what you pay in taxes will allow you to use the cash to accomplish not only your immediate lifestyle goals, but your legacy goals. When I think of investing in your legacy goals is contributing to your retirement versus allocating the funds for taxes. Now, of course, I don't want to say you're never going to pay taxes. Of course you are, especially when you make more money. But when you have grown in business, it's going to be imperative to have a tax strategy so that you can essentially, in a way, kind of dictate what you do pay in taxes. So you're currently not able to dictate or at least understand what you are expected to pay in taxes because you do not have a tax plan. One of the biggest mistakes for business owners is not having a tax plan because that turns into a tax surprise and you end up overpaying in taxes because there's no plan, right? There's no plan to legally reduce your tax liability. For our bookkeeping clients, we provide at least monthly tax estimates so that they avoid as much as possible those tax surprises. Now, this is contingent on making sure that we have all the data that we need, right? Because if we don't have your prior tax return or like your personal taxes, right? Because that contributes to a lot of what you would pay in taxes. Say, for example, if a client is married and her husband is also a high earner and we don't have any like previous tax returns or any like W-2 or paycheck stubs, it's going to be hard to create a realistic tax estimate. So I kind of say, yes, we want to guarantee like no extreme tax estimates, but that is contingent on what our clients deliver to us so that we can create the most realistic tax estimate possible each and every month. And then with quarterly taxes, we'll say, okay, based off of what has transpired for this year so far and your tax estimate, let's pay X to the federal, X in state. And then for our CFO clients, we go a bit deeper. And not only do we have the estimates, but we have specific tax strategies to help them essentially be able to kind of dictate what they pay in taxes. Because when you have a tax strategy, you're legally reducing your tax liability. I want to just be clear with the difference. I'm sure we all know the difference, but I just want to have it here on the podcast, this episode, right? Or the difference between tax preparation and tax planning. So tax preparation is taking all of for a business owner specifically, you take all of your business financial documents. So that includes like your income statement. If you are taxed as an S Corp, that will also be your balance sheet. And we're taking that data and we're putting it on a tax return and showing the government that this is what transpired in this business. On the personal side, you're taking your end of year tax documents like your W-2, your 1099s, your interest income, like your dividend income, your mortgage, like the 1098, your student loan payments with your interest in there. All those documents kind of create like hey, this is what happened for this year. Let's hand it over. Let's put it on a tax return so that we can see, based off of your taxed earned income, what your tax liability is going to look like. This is reacting. We're just taking things, putting it on there, calling it a day. Versus a tax plan is essentially, right, you're planning for taxes. And that means that throughout the year, you're leveraging the tax code so that you can essentially dictate what you pay in taxes. So during this episode, I'll go in depth of what I do personally or have my clients do throughout the year so that they can say, okay, if my tax liability based off of my profit is X, we can do a couple of these strategies to kind of reduce them and also not go into the tax season with a tax surprise. So stay tuned. So the first way that you dictate what you pay in taxes through a tax plan is aligning your major personal goals with your tax plan. Usually when it comes to business owners, they blindly try to write off every single thing for taxes to avoid paying taxes. That is not a tax strategy. Writing off every single thing in your life is not a tax strategy. Yes, it can reduce your tax liability. However, you need to holistically see, okay, what are your goals financially for the next couple of years? So if you're trying to buy a home, you have to show adequate taxable income for at least 2 years so that the mortgage company can say, okay, this person based on their income can afford this home. If you're deducting every single thing in your business or just kind of trying to find everything to kind of deduct, it's going to be hard to say, okay, your taxable income will be depleted potentially, and that will hinder you from making choices such as buying a home, investing in real estate property, or specific things that you want to do. So just kind of really understand what are your goals so that you can align it with your tax plan. Another thing that I see is people and accounting professionals are typically more reactive versus proactive. So when it comes to on the individual side or the entrepreneur, unfortunately, there's a lot of angst when it comes to taxes. So instead of facing it or having a separate account to save for taxes or paying it quarterly or having it aside, you're ignoring it. And there's years of taxes that you owe. And instead of having a payment plan, you're procrastinating, unfortunately. And you're letting it pile up to a point where by the time that you're ready to do a payment plan, it's already too big. So you have to pay off a chunk to be able to put yourself on that payment plan. When I first started my business and I was doing bookkeeping and we were helping clients get ready for tax season, their tax accountant assumed that things will not change year over year. And then when a client went from 300,000 to $1 million, I've seen that a few times, there was a reaction of, oh, snap, now we have to get into gear. We're taking this business seriously. So it's going to be really important, like when you're thinking about having a financial team for your business, knowing what every person should do for scope of service and having it be explicitly clear so that there are no surprises when it comes to your taxes. We don't want to play with that at all. So with our clients, we have a profit planning intensive as well as CFO services where we go deeper into understanding the client's goal personally, because when you understand someone's goal personally, you're able to then reflect it in the business by working backwards. With our clients during a legacy call, we understand, okay, what are their big goals? What are their immediate lifestyle goals? And how can the business reflect those goals or accomplish those goals in the next year, and also how will it trend for the next 3 years. In the fourth step of my Harmonious Wealth framework, we have a profit planning session. When we wrap up your profit planning session, that's after we go over your revenue, we understand the metrics to get to your revenue goal. We do a profit plan so that we highlight investments, what you're paying yourself, expenses, make sure that we have the guidelines so that you have the profitability that you desire and that you need to have a healthy business. We will then create a tax plan based on the profit that we projected for you for that year. And then with that, we'll be able to kind of split it between two different choices. Like, okay, choice one, we do this, nothing changes. This is what your tax bill will look like. And then the second option is adding certain things for tax strategies, which I will share next, and then seeing how that would impact tax liability. And then each month, we will then do tax estimates. And then we'll say, okay, this is what we initially projected. This is the actual. Let's see where the variance is. So when it comes to helping clients manage previous tax bills, we initially help them create a payment plan that is going to be like a no-brainer to pay automatically every single month. And then, of course, that will involve you having a little bit more taxes to pay over time. But instead of stressing yourself out of paying it off in full and it impacting your immediate cash flow, what we'll do is suggest different ways, like different payment plans that is a no-brainer to pay every single month. That way, say you have a launch month later and we allocate that cash or some of that cash to take off a chip of that debt, then we'll be able to help you pay it off sooner, but you're locked in for payment plans that are extremely easy to pay off. Next, I want to share like some actual strategies for taxes that'll help you reduce your tax liability. And if you are wanting to get my top 7 tax strategies to reduce your tax liability legally, go to lovelyfinancials.com/tax. So changing your company's tax structure, potentially, right? This isn't an automatic thing. You should be talking to your tax professional, talking to your finance team to see holistically if this is something that you should do, and then also listening to your gut. Typically, when it comes to online business, people are blindly transitioning to an S Corp preemptively before they're ready. So they're doing it because everyone else is. They don't have the proper support to get them started, and they might be starting too early. They might say, okay, I've had an amazing year, and they don't have any projections for the future years. So they don't know exactly what the next year will bring. And then the next year comes and they weren't able to sustain that S Corp. Now, on the other hand, things happen, right? Things unexpectedly happen. And say if you have a business that's been thriving for the past couple of years, and then you had a really rough year and you weren't able to really pay yourself that salary, that's 1 year, right? What can you do to reframe your mind to say, okay, what should the next year look like? Versus like really harboring in and feeling bad about that current year. So I'll just say on the other side of starting too early, you might be starting too late. So typically when you're starting a business, you have an LLC. If you're the only owner, you're going to be taxed as a sole proprietor. And that means not only will you have income tax, but you'll also have self-employment taxes. So when you transition to an S Corp, when it's the right time, when you have the right support, you can save yourself the self-employment taxes. Typically, I see that it might be time to transition to an S Corp when you're consistently making a full salary, like your net income looks like a full salary. So let's say if it's from 75,000 plus, that to me seems like a good idea to transition to become an S Corp. And a mistake that I see is people having like extremely minimal wages and having extremely large draw. So what I mean by that is you can dictate your salary in a way as long as it aligns with reasonable compensation. So let me kind of pull back, right? An S Corp is a way for you to make yourself an employee. It's still a pass-through entity. And what you'll need to do is put yourself on salary that is reasonable, meaning not 20K, and then you're taking 100,000, 120,000 in your draw. So your draw is not taxable. It's basically you're paying yourself from the profits as a business owner. So you're paying yourself equity, the equity that's left over. Remember in episode 8, I talked about the balance sheet, and that shows us assets, what you own, liabilities, what you owe, equity, what's left over. And when it comes to your draw, you're paying yourself from that equity because it has that net income and the equity that you've been keeping in the business year over year. My approach to helping clients navigate tax season and their tax plan is to first and foremost connecting with their tax professional. It's going to be imperative that whoever's doing your bookkeeping, whoever's doing your financial management with your cash flow, like with your financial strategy, is talking to whoever is doing your tax prep. It might be the same person. We just personally don't do tax preparation. So we will work collaboratively with your tax professional. And if it is time to transition from a sole proprietorship to an S Corp, there was a form called a 2553 form that elects your LLC to be taxed as an S Corp. It is due on March 15th of every single year. If you're discovering that you should be an S Corp after March 15th of that calendar year, that means that you will have to do a late election, and it'll be at the top of the form, and your tax team should be able to handle that for you. While you do the form and you turn it into the IRS, it's going to be imperative to start getting on payroll expeditiously so that you can start paying yourself that reasonable compensation. And if you elect it for the beginning of the year, you can kind of do what I like to call a catch-up payroll so that you can satisfy reasonable compensation for that tax year. There's also a way to do it like mid-year, but that, to me personally, I would rather you do it for the full year, or if not that calendar year, the next year, starting with a clean slate is also a good option for you. When you become an S Corp, there are a couple of things besides saving self-employment taxes that you can deduct in your business. One of them is your healthcare premium costs. So say if you get your health insurance from healthcare.gov and you're an S Corp, your premiums, like your health insurance premium, can be deducted on your W-2, which is an expense for your business because that's part of your salary. So then that way you can leverage your healthcare through your business as a tax deduction. So on top of this, when it comes to not only your premiums, you can get an HSA through your business or personally, and your business can contribute to your HSA as a business expense. So not only is your healthcare covered by your business, like your healthcare premiums, your out-of-pocket costs are also covered through your business because your business is contributing to your HSA. Now, for this tax year, HSA contribution max is $4,000. So say if you're on a high deductible insurance plan and you don't really have a lot going on, you don't have like chronic illness or anything like that, your health care will be pretty straightforward. You're just kind of maintaining everything. This will be a great opportunity to dig more into to see if this is a good option for you. Personally, I have a high deductible insurance plan for this year for myself. My daughter is on her father's. Thank you, Jesus. I don't have to pay her insurance this year. So I have my own insurance. It's paid through my business's payroll account, comes out every month, and then I'll contribute to my HSA. So say this year, I want to get really serious about my hormone health, just making sure everything's good. I can deduct things like my out-of-pocket costs for like labs. I did a whole thing with lab, just on to look at every single hormone, not every single, but the ones that talk about fertility and making sure that I'm good. And I want to be sure, and you could do things like massages, a chiropractor, you can get your supplements with your HSA. There's things that you can do with your HSA that people don't talk about. Look into that for sure, so that you can leverage not only the tax structure, but your health benefits. Another benefit for changing your tax structure to an S Corp is retirement. So I'm going to only talk about a solo 401k just so that, because it's really simple. I don't want this episode to be too long. In episode 5, my client Nagina talked about how she used her solo 401k in her business as a deduction. But before that, she was able to master her profitability, and she shifted from 30% to 70%. So that 70% buffer for profit was able to be utilized to max out her contributions. As a business owner, she's able to contribute both personally and through her business. So it's kind of like a double tax deduction when you're able to leverage this for your business. So 2024, as an employee, your max contribution rate is $23,000. But as a business owner, you can contribute on the employer side. So jointly, your max contribution for 2024 is $69,000. So imagine When you have a way to increase your profit and you're able to you allocate that profit to your future self, ooh, that'll be amazing. The next tip in how to dictate what you pay in taxes is by aligning your everyday goals with your tax plan. So first we were talking about like your long-term goals, getting on the right tax structure. Now, what are the nuanced, like everyday things that you can do to reduce your tax liability without just like being fruit ninja and like deducting every single thing? I know I love you, but we are not going to continue to do fruit ninja with our cards, commingling our business and our personal expenses because we want to evolve from this. So this is typically what happens, especially when you first start your business. No judgment, but I do want to remind you, like, let's really treat our businesses like businesses and separate our business and personal finances. Typically, when it comes to having a business as well, you're not thinking, okay, what are some things that I do naturally that I can actually deduct in my business without depleting my taxable income? So one of the things is like not involving your kids at all, or you're involving them, but you're not seeing how can I leverage the tax code to kind of pay my children so that they can succeed or have a plan for them for their future. My approach to this is when I'm first meeting with clients, even on a sales call, I'm asking, okay, do you have children? How are they involved in your business? Do you do video in your home? Things like this. I might not ask all of this during the sales call, but I'll definitely ask this throughout our time working together, especially with my intensive clients and my CFO clients. When I ask these questions out of curiosity, I'm planting seeds of, okay, how can we leverage your children, not leverage your children in the bad way, right? We leverage how your children are helping you through your business. Maybe they show up, they could be like used as talent for like marketing campaigns. I have a client, she hired her children. She does a couple of like podcast episodes with her children to kind of gauge like the children's perspective on particular topics. That's absolutely a way that you can leverage paying your children through your business. And it's not only a tax deduction, what you pay your children can go to their future. You can open a custodial Roth IRA so that you're hitting all those points and investing in your child's future so that you can satisfy dictating where your taxes go versus just paying it blind. Another thing is like say for example, I'm using my living room as my podcast studio these days in this season of my life. So I can utilize the Augusta strategy. And with that, typically when you have a home office that's used only for work, I'm not going to tell nobody, you can deduct the square footage of your office against your entire square footage of your home. However, when you do like things like a podcast episode, YouTube videos outside of your office, you have like executive meetings, like your team comes, they meet with you in your home, or you have quarterly executive meetings as a CEO, you can do what is called an Augusta strategy, where you're paying personally you. I can pay Iyanna, Lovely Financials Group can pay Iyanna to rent out Iyanna's home for the purpose of producing content. Now it's going to be 14 days or less because that allows you to have tax-free income. So say, for example, if this is an example, you don't have to take it, but if you want to gift yourself something for your launch, right? But you want your business to pay for it, you can actually do something like record content. You can pay yourself tax-free, and the money that you pay yourself that's extra, you can use that towards gifting yourself. But it's going to be really important to make sure that you research the going rate for renting a meeting space in your area. So say, for instance, I live near a mall and it has some hotels. I would have to do some research on what is their going rate to rent out meeting rooms so that I can have a comparison so that I'm not just charging anything for renting out my home for the day. So you have to do a little bit of research, but you are able to utilize it so that you can kind of dictate, okay, if I want to gift myself something, but I'm actually doing something legit, in my business for marketing and I'm renting out my home and it really makes sense, it's on my calendar and I can prove it, then you can actually leverage this one. And again, like if you want to get our 7 tax strategies for business owners, go to lovelyfinancials.com/tax. Another thing that you can do is, say, if you want to buy a car through your business, but it really depends on the type of business that you have. So just be really careful with that. Say if your business fits the criteria to be able to purchase a car and it makes sense, whatever you purchase the car for, as long as it is new to you, you can do something called a 179 deduction. Say if I buy a car, it's $30,000. Even if I'm financing the car, the cost of the car can be deducted completely. That $30,000 can be deducted completely during that tax year through a 179 deduction. This is contingent on me making sure I'm doing my due diligence. It fits my business. So if I'm a videographer, this will be a good option for you. Or if you're a photographer, it could potentially be a good idea for you to, if you are in need of a car going through that. But talk to your tax professional to see if that is a good idea. So we talked about some bigger ticket things when it comes to aligning your everyday goals with your business. I don't want leveraging the tax code to turn into you splurging on your lifestyle. Like you don't have to do first class whenever you're traveling. You don't have to do 5-star hotels every time you travel for business. Be really intentional on how you're investing in your business. And then the reward for that is having your lifestyle funded through your business, but you're not depleting your profit and your cash flow in the process. So another example, I mentioned that with your HSA, you can do things outside of like your typical copay lab result, like paying for your lab fees. And you can do like massages, like your supplements, your like chiropractor visits. So massages, maybe that's on your immediate lifestyle goal and you want to have a massage at least once a month. If that fits within your budget cash flow wise, you can leverage your HSA to pay for this. And say if you're going on a trip and it's a weekend trip, you can say if you want to share with your email list that you'll be in whatever city. And if they want to have a VIP day, then you can essentially, as long as it's on a weekend or it makes sense, we have to be really clear, you can deduct the trip for business purposes. Again, if it aligns with your goals, your bigger goals and your immediate lifestyle goals. Now, say if you have a VIP day, it'll hopefully wash out your expenses for that trip so that you can leverage that. So you can use that for your business. Okay, so I talked about ways to dictate your taxes in your business, along with making sure that it aligns with your long-term goals, it aligns with your everyday goals, and potentially shifting your tax structure so that it works out for your business. Which one of these are surprising to you that you didn't know before or that you want to double down on for this year? If you're watching on YouTube, let me know in the comments below. So we talked about how to dictate your taxes in your business by leveraging the tax code and having a tax plan in your business. Sign up for the Harmonious Wealth Tax Planner so that you can see my top 7 tax strategies that I use for myself and my clients in business. The Harmonious Tax Planner will help you understand the beginning steps that you can use for your business as you grow. You'll be able to know how I use them for my clients and how it can benefit you. Go to lovelyfinancials.com/tax to get started. If you're a woman growing your business and family and want to heal your relationship with money and release your anxiety with taxes to build personal wealth and create a legacy, subscribe on either YouTube or wherever you listen to your favorite podcast. I'm on a mission to help 100 women reach at least $1 million in net worth so that they can create generational wealth and break generational curses. If this aligns with you, I'd love for you to be a part of our community. So tune in to future episodes to Harmonious Wealth. Hey there, girlfriend. If you're ready to finally have the lifestyle and legacy to show for your business success, I would love for you to click that subscribe button on your favorite podcast app or YouTube.